Okay, so I'm going to talk kind of like in a very general sense about a few of the things that you should be thinking about from a tax perspective in terms of startup. It's obviously it's difficult to pick what to talk about in a quick session. So what I'm largely going to think about is, I guess, tax from the perspective of how your startup vehicle is set up. And then a few of the things that have kind of a lot of tax impacts, which are largely around incentivizing employees and getting people on board with your investment vehicle. And then also just going to touch on a couple of reliefs which are very relevant from a tax perspective for initial startup companies. So this is all going to sound very kind of basic to start with, but it will hopefully make sense in the context of where I'm going to get to. So in terms of how you're set up as a business when you are a startup, obviously a lot of people will start and they'll just be working by themselves. They'll be effectively just a sole trader. So you've got very basic tax points to think about there. You've got a very simple structure. You're going to be charged to income tax on any income that you're making, and if you sell your business in the future, you're going to be charged to capital gains tax. Sales of businesses, if you're selling the whole of your business, generally will qualify for relief from capital gains tax in the form of entrepreneurs relief, which reduces the rate to 10% from 20%. So obviously that's something to very much be aware of. And there are a lot of benefits to being kind of a sole trader, but only probably in a very short-term sense. So it's quite simple. You just have to do a self-assessment tax return. You're you've got limited filing obligations. You've got quite a lot of privacy because in the UK, nobody's entitled to see your tax return other than the revenue. You have to disclose it more widely. And you've only got kind of one layer of tax to think about. So you've got to think about what your tax position is, and that's about it. There are obviously, though, some negatives more from a commercial perspective with being a sole trader for tax and general purposes. So you've got unlimited liability. So everything is potentially on the line if there's a problem. You've potentially not got as much access to finance arrangements. In particular, you've not got any capital structure in the form of a company, which I'll come on to, which you can use for various reasons. And you're not, Giles touched on, at some point you might want to work towards some sort of M&A or private equity investment. You're not kind of packaged up for that particularly because most businesses people are going to want to invest into or purchase in the form of some form of corporate vehicle. So partnership is going to be very similar from a tax perspective because you just look at individual tax treatment for partners, but you just need to think about an extra layer of kind of legal side of things is that you need to obviously regulate the terms of any partnership that you've got in terms of who's entitled to income, who's entitled to capital, and how you actually run a business once you're in a partnership. And it's something that a lot of people forget or think is all going to be okay until it's not. And that's something that Giles will touch on more in terms of shareholders agreements. But everything needs thought if you're in business with people, basically. So this is the more interesting stuff, and this is what we're more used to dealing with. So if you've got a company, you've stepped into the realms of corporation tax. So you're going to pay corporation tax on any profits that you're making, and you're also going to pay corporation tax on any gains that you're making as well. So generally you're going to be paying tax at the same rate, albeit you've got two different types of tax there. So tax on profits and tax on kind of chargeable gains is two separate kind of remits. So that's kind of the perspective of the company. Once you get into a corporate structure, you've then obviously got a lot more complexity in terms of filing obligations and what you've actually got to do. You've got to put accounts in a company's house potentially, unless you're very, very small, and you've got less privacy because everything is available in terms of company ownership structures, accounts, etc. at company's house. So you've got less privacy, but generally speaking, it's the vehicle that we will see because you've obviously got limited liability once you're in the guise of a company, and you have got access to probably an awful lot more in terms of you've got a share capital structure, so you've got people who can invest into your company. It's something that people are more used to. You've kind of got more credibility that goes along with it. Once you have got a company, though, you've obviously got to think about actually extracting money from the company and how that works from a tax perspective. So you have got kind of two layers of taxation to think about. First, any profits or gains that are in the company, how are they going to be taxed? And then secondly, how am I going to get things out in a tax efficient, or even if not tax efficient, how am I going to get things out? So the normal things that you would see is obviously people will pay themselves salaries and bonuses, and we'll often see that that will be structured so as to maximise the benefit of things like the annual allowance and kind of keeping you paying 20% tax within that kind of realm. You can obviously extract dividends from a company if you are a shareholder of it, and the tax rates on dividends are slightly different to the tax rates on income, slightly less. In some cases, it kind of changes depending on your marginal rate. It's not that straightforward. You can also have a company provide its employees and directors with benefits, so things like pensions or medical insurance or various things like that. And obviously there are a lot of benefits which can have tax advantages attached to them, and then there are a lot that are just effectively taxed as income. So there are kind of two layers of tax that you need to think about there, like I said, and it's just a case of kind of picking how the structure works for different people from I guess from a commercial perspective as much as anything else. Once you have got a company and you're a shareholder of it, obviously if you're working towards a sale or some form of exit in the future, you also want to know that you can do that in a kind of a tax efficient way. Where you sell a company which you have had as effectively your personal company, so you've had all of the share rights and you've been an employee, director, and you've held it for long enough, then you'll generally be qualifying for entrepreneurs relief on the sale of your shares. So again, that will hopefully mean that you will pay capital gains tax at 10% as opposed to 20%. And there's a lifetime allowance there of £10 million. So that's obviously a massive, massive benefit from a tax perspective. Entrepreneurs relief is something which you have to be careful to structure correctly. If you are a sole shareholder and director of a company, then it's hopefully something that you don't have to worry about too much because you clearly own 100% of everything. But where you get other people involved, or where there are where you have investments later in the future, you have to make sure that you've got the rights correctly structured so that you definitely are going to qualify. They changed the rules for entrepreneurs relief last October, and to qualify now you have to be an employee or director for 2 years before a sale event. You have to hold 5% of the voting rights in a company, and you have to hold 5% of the economic and nominal value of shares. So you actually have to genuinely have at least a 5% entitlement to whatever's going to be extracted from the company at the point of a sale, or kind of when it's wound up in the future. That's slightly different to what the position used to be. You used to be able to structure entrepreneurs relief so that you had 5% of the voting rights, you were an employee director for the requisite period, but you didn't actually have to necessarily have the 5% economic entitlement. They've changed that because the revenue don't like that and the government don't like that. So that is now off the table. So entrepreneurs relief structuring is something that's really important, and important to get right as soon as possible because of how valuable it is. But it's something that now does need slightly more thought than it used to have. So definitely worth taking advice on once you get past being just you and your initial founders having a company. So that's generally kind of the different structures that you can have. I just wanted to touch a little bit upon the capital point that I mentioned before. So I mentioned that it's helpful once you've got a company that you've actually got kind of share capital, and you can use that to incentivize people and to take forms of investment. So what I mean by that is obviously you've got shares, so you can actually do something with shares, and you've got kind of hopefully value in those shares in the future. So if we assume that we're going to work towards some form of future exit, so you're going to sell the company, or you're going to partially sell the company and stay involved in some way, or you're going to have an investment from outside, that investment and that sale is going to take the form of some sort of investment into shares or some sort of sale of shares. So what you want to do is, like I said, make sure that you've got entrepreneurs relief structured, so because that's going to get you hopefully the best rate of tax on that future exit event. And then you also want to think as soon as possible within the lifetime of business about kind of various incentive schemes and what you can do to get your employees and your key people involved in that kind of future exit with you. Because obviously, as you all know, your key people are the people who will get you towards where you want to be in your company's lifespan and towards an exit potentially, or towards an investment, and they're the people who actually drive the business and do what you want it to do. So you want to reward them for doing that in the most efficient way. Obviously you can always pay people salary and you can always give people bonuses, but those are not very tax efficient methods to get anything into somebody's hands, because marginal rates of income tax are exceptionally high as soon as you get over a certain threshold. So the other things that you can do is you can use the equity, so the share capital in your business, or the to effectively incentivize people. So what we do a lot of at Squires in the context of small startups and also much bigger companies is we do work on share option schemes and share incentive arrangements. And so what that normally means is you're trying to get somebody a right over some equity in the company. So you're effectively saying to them, in the future, if, for example, we sell this company, you can exercise this right over shares that you've got, and you can effectively participate in the sale with us. So you can join us in the sale and hopefully do well out of this with us. We're all working towards the common goal, and everybody's going to do well in a kind of similar way together. So a share option scheme that is exceptionally useful and very applicable to startups, and something that we work with an awful lot, is enterprise management incentive scheme. And so the benefit of that is largely you're going to get people into capital treatment. So you're going to get people into capital gains tax rates, so 20% at the highest, as opposed to income tax rates on the incentivization that you're giving them. There's also a massive incentive with EMI options, in that I mentioned that to get entrepreneurs relief, you normally have to have 5% of the economic value of the company. For EMI schemes, you don't need that. So you need to have held an EMI option for 2 years, and you need to be a director or employee for that period. But you can get entrepreneurs relief as long as you have held an option for long enough, no matter how many shares you're going to be getting. So in terms of incentivizing your employees, as long as you can get options granted to them at the right stage, it doesn't cost anything to do that, other than obviously the setup costs of putting a scheme in place, which are not that high. You can potentially get somebody benefiting in a very tax efficient way with you in the future on the sale. So everybody's working towards that goal together. And it's an HMRC approved or as such scheme. So it's not any form of sort of tax avoidance or anything like that. It's a fully fledged, everybody should be doing it if they can possibly do it. There are a lot of rules that apply as to whether or not you can do that, but I would certainly say that at startup stage and at kind of like early to mid level in terms of business progression, it's definitely something that should be thought about. So something else I wanted to touch on, which again comes back to the kind of capital structure side of things, are a couple of investment schemes which have tax advantages attached to them, which are very applicable to startup companies. So one of them is SEIS, which is the Seed Enterprise Investment Scheme, and then one of them is EIS, which is the Enterprise Investment Scheme. So the two of them, I don't know if anybody has heard of them before. They're very similar, but they're also very different. So SEIS is the kind of smaller investment scheme that's aimed at very, very entry-level startup businesses, and EIS is the kind of slightly bigger one which applies to more businesses, but again it's entry-level. So these are both tax incentive schemes which encourage investment in startup trading companies, and it's kind of in recognition of the fact that startups will struggle to find other forms of investment and to raise finance in the way that traditionally larger, more established businesses can. And so what these schemes both do is that when an investor makes an investment into shares in a startup business, they provide tax relief for the investors in the form of income tax relief and capital gains tax relief. So there's a positive there and an incentivization for an investor to put money into a startup. From the investor's perspective, obviously, that can be a fantastic incentive for them. If somebody's paying an awful lot of income tax, everybody wants to pay less income tax. So if you get a massive income tax deduction, then that's fantastic. There are also CGT reliefs that attach to EIS and SEIS investments. They're slightly different on both of the reliefs because they didn't think it would be straightforward to make them the same, and they like to keep us busy. And also they apply ever so slightly different reliefs. So just thinking of it in kind of CGT relief is probably the most straightforward way to do it without going into too much heavy detail at this point. So that's what you have to think about from the perspective of the investor. But SEIS and EIS are, while they're really good schemes from a tax relief perspective, they are very, very, very complicated schemes. And so there are an awful lot of conditions that apply, both for the investor and for the company. So for example, in terms of the company, EIS and SEIS, because they are giving such beneficial tax favour treatment to the investors, they have to be companies where people are genuinely having a risk attached to their investment. So you have to be putting money in, and you effectively have to be at risk of getting less back than you put in, and your net return has to be potentially going to be less. So they're really looking at letting these reliefs apply to companies where there is a genuine kind of like entrepreneurial growth prospect there. It's not meant to go into companies where there is no risk and your money is as good as coming back to you as soon as you put the money in. That's not how this is meant to work. There are also a lot of kind of qualifying timescale periods. So, for example, an SEIS company has to be less than 2 years old. An EIS company generally has to be less than 7 years old. Sometimes it can be less than 10 years old when investment is made. So, again, this is aimed at young startup companies which are finding their way and which need investment for the purposes of business growth. The money that is raised has to also be used for the purposes of the trade of the business that the money is put into. And there are kind of quite strict requirements as to what being used for the purposes of the trade has to mean. So, for example, you couldn't just take the money and sit it in a bank account or take the money and invest it in something else, because that's not actually progressing the trade that the startup is dealing with. It has to be money that's used, and there are kind of restrictions and rules in terms of how the relief can be claimed as to how when that money has to be used by. So again, it can't just sit there forever. There are also holding periods that apply to the period of time for which an investor has to hold shares, and if they don't hold them for that period of time, then they don't necessarily get the tax reliefs that we touched on. But generally speaking, SEIS and EIS can apply to either companies which are beginning to trade or thinking about beginning to trade, or which are carrying out research and development for the purposes of trade. But again, between the two of them, there are slightly different rules as to at which point you are treated as being kind of eligible to receive investment via one of these routes. As I've probably already touched on, they are very complicated tax reliefs, and there are a lot of awfully complicated provisions attaching to them. And the main thing is that there are lots and lots and lots of ways in which investor relief can be withdrawn, and that can be both from an investor perspective and also from a company perspective. So I once had a client say to me, "Can you tell me what I need to keep doing to keep EIS and SEIS relief for our investors?" And actually, when you sit down and try and look at that as an advisor and try and write a list of this is what you need to do and this is what you don't need to do, it's really difficult, because there are literally hundreds of ways that you wouldn't even think about until they happened that these things can unravel. So the main kind of piece of advice that I would have in terms of EIS and SEIS is that it's really important to take advice, because obviously you're saying to your investors, please invest in me because this tax relief is going to be available to you. And you are effectively hoping that this will be the case. Obviously, if something really silly happens, or if the structure of the investment is not done correctly, then the relief that gets taken away, it's a lot less attractive for that investor to invest in you. And so it's important to take advice and make sure that the kind of like the T's have been crossed and the I's have been dotted in terms of EIS. SEIS, I've just got a few points to flag here. So it's the kind of big brother of EIS. So the limits are slightly different. So you get 30% tax relief rather than 50% tax relief. So it's not quite so beneficial, but you get it on a bigger limit. So it's £1 million unless you've got a knowledge intensive company, which can have investment of up to £2 million that will qualify for relief. So what a knowledge intensive company is effectively either a company which is generating IP that will be largely used for the purposes of the business going forwards, or it's a company which has got a skilled workforce. And again, the rules on that are very complicated, but in a nutshell, it pretty much means that I think 20% of your employees and staff have got a higher educational qualification and are directly involved in research and development type activities on a day-to-day basis. So knowledge intensive companies is kind of trying to get at what it says on the tin. So companies which are doing really, really intensive research and development and kind of innovating and progressing something along those lines. Again, the CGT relief and the holding periods apply for shares in the same way as they do for EIS. But again, the actual reliefs for CGT purposes are slightly different, because why would it be fun to have them the same? And you can actually claim SEIS and EIS in the same company for an investor, but there are kind of rules as to how that actually has to be structured. So you used to have to use your SEIS funds first. You don't have to do that anymore, but you do have to raise the SEIS funds first. And so part of the structure of getting these schemes in place is that the company has to issue a certificate, which it goes through a process with HMRC for. And if, for example, you were trying to have an SEIS investment and then you accidentally issued your EIS certificate too soon, then SEIS is off the table for you because the SEIS technically hasn't come in first. So, like I said, it's a complex list of the order that you have to do things in, but you can do both in one company, which is definitely a positive. You obviously just have to make sure that the conditions for both sets of reliefs are made. One thing to flag as well, 2 points to flag, is that you can't have these reliefs where the investor who is investing in you has got a kind of interest in the company or too substantial interest in the company, or where they eventually ultimately will have. So once you've got people who have done kind of one investment and they're doing another, you have to be very careful that you're not going to start tipping over any of the limits that apply. And there are also different rules that apply under each set of schemes as to what you can do with directors and employees. So generally speaking, the starting point that I like to think of is that if you're a director or an employee, you're off the table and you can't have an investment that will qualify for one of these reliefs. But there are ways in which you can actually get around that. So for SEIS, generally, you will be able to make an investment that qualifies if you are a director. But there are rules that apply. And for EIS, business angels who effectively are just an unpaid director or being kind of reasonably remunerated only as they need to be can generally get into one of the reliefs. But again, lots of conditions apply. So the main takeaway from EIS and SEIS is that they're both really good reliefs for investors, and so therefore they can be really, really useful for startup companies because it's making somebody's investment in you really tax favoured for them. But they're really things not to enter into lightly, and advisors don't enter into them lightly, even if they see them all the time. Like, it's so easy to slip up on the conditions. So definitely something to take advice on.